Sometimes it feels like a trough and a cycle never ends. Revenue declines for yet another quarter. Earnings bouncing up and down, but never trending upward. Free cash flow slowly sinking. At these moments, investing is at its darkest. It is here you must remind yourself why you invested in this business in the first place. But then it happens. An earnings report springs forth with green shoots in all directions. Beats the estimates, double-digit growth, raised future outlooks. Finally, the light at the end of the tunnel is shining. And for Texas Instruments, this earnings report finally shines brightly. Welcome to the Quality Investor. Texas Instruments has been a frustrating investment the last couple of years. The share price has ping-ponged up and down, which has scared some investors due to free cash flow concerns. See a video I did last year on that topic. But other investors, me included, trusted that this was a temporary blip on the path to future long-term growth. Yes, for the first time in many quarters, a truly positive earnings report was released by this analog semiconductor giant. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Semiconductors are a notoriously cyclical business. Demand for chips fluctuates rapidly due to technological innovation and ever-shifting consumer behavior in electronics and industrial applications. When demand spikes, inventories are overstocked to avoid shortages. Additionally, new fabrication plants break ground to supply this demand. However, these require massive upfront capital and take years to build. Demand has often cooled by the time these plants come online. Now the market is oversupplied and inventories need to adjust downward. This has been the story for Texas Instruments. They are right in the middle of a capital investment cycle expected to last through 2026, and demand for analog chips, especially in the industrial and automotive sectors, has been slow to ramp back upwards. And then tariffs happened. TXN does produce some chips in China. However, it is not a significant amount, and these plants primarily serve the Chinese market. But 19% of TXN's revenue is still derived from China, and many chips manufactured in the United States by Texas Instruments, their primary fabrication base, make their way to China. The same China that slapped 125% retaliatory tariffs on U.S. imports in response to Trump's China tariffs. This caused Texas Instruments' share price to fall hard. The stock is down 15.33% since April 1st and has faced massive volatility, sometimes swinging over 10% in a single day. Just take a look at their stock chart here. Texas Instruments' share price has had a rough go since the beginning of April when Trump first announced his tariffs. A lot of the semiconductor industry is based in Asia, and a lot of manufacturers, especially US manufacturers like Texas Instruments, have many customers in Asia as well, and especially China. And you can see that volatility here in their share price. You can see the green dashed line is the high for that day, and the red dashed line is the low. And look at that crazy volatility in early April. Huge swings throughout the day in share price as these tariffs were all ramping up. The volatility has lessened in the last 10 days or so, heading into yesterday's close of $152.15. But for Texas Instruments, the damage has been done. Like I said, down 15.33%. However, they are up big today after this latest earnings report. This earnings report, however, gives investors optimism about the state of the semiconductor industry. The first signs of improving demand are starting to hit the top and bottom line. Today, I want to review this earnings report, discuss what it means for the broader semiconductor industry, and assess what a good entry price is for this semiconductor titan. So let's get into it. TXN is having quite a day in the market They're up over 7% at the time of this recording, sitting at $162.96. The broader market itself is having a very green day, but the market is particularly pleased by Texas Instruments' earnings report. On the earnings call, the CEO did allude to high uncertainty due to the tariffs and geopolitical disruptions. However, he also stated the semiconductor cycle has bottomed and that TI is well positioned to capitalize on the growth cycle going forward due to its capacity. But I think what really has the market excited about this earnings report is the fact that they raised their guidance for Q2 in 2025. Their Q2 revenue guidance sits at $4.17 billion to $4.53 billion, which is compared to the Wall Street estimate of $4.12 billion. And what's better about this earnings report is that they even stated that this is a cautious outlook due to the dynamic environment. So not only did they raise their guidance, they raised the guidance in a cautious manner and still beat expectations on the street. I also mentioned that we're starting to see a demand recovery for semiconductors as a whole. And you see that revenue increased 11% from the same quarter a year ago and increased 2% sequentially. But more importantly, all of our markets grew sequentially, with the exception of the seasonal decline in personal electronics. Of course, that seasonal decline is post-holiday season. In specific markets, the CEO mentioned that industrial was up upper single digits, automotive was up low single digits, enterprise systems are up mid-single digits, and communication equipment is up 10%. So we're starting to see that growth cycle coming back in to the semiconductor industry. And another interesting aspect was a question that was asked in the earnings call. One of the analysts asked, is the Q2 guidance gains due to tariff-related pull-ins? Meaning, did people shift some of their buying behavior into Q1 prior to these tariffs being enacted? TXN said the Q1 recovery was driven by industrial demand and not tariffs. And in fact, they don't see an immediate tariff impact. So you could argue that the fall in the market for Texas Instruments, not only in April, but over the course of 2025, has been driven by fear around tariffs than actual impact of tariffs on the business. And looking at the income statement here, we can see that large increase in revenue, $4.1 billion in revenue, an 11.14% year-over-year increase. This comes after over 8 straight quarters of revenue declines. So it's nice to see Texas Instruments finally getting back into the growth column there. And the operating margin increased as well. 32.5% this quarter, up from 31.7% in the quarter a year ago. The net margin year over year is down slightly to 28.98% from 30.2%, but that is largely due to this one-time benefit of restructuring charges that Texas Instruments received last year. And finally, the earnings per share, up 7% to $1.28. Looking at the cash flow statement, operating cash for this quarter is down a little bit from the prior year, $849 million compared to $1 billion from the prior quarter last year. And that's down due mostly to working capital changes, so nothing too much to worry about there. They did have $1.1 billion in capital expenditures in Q1 of 2025, down slightly from the $1.25 billion in capital expenditures in 2024, but this is going to be elevated throughout 2025 and into 2026 because of the massive capital cycle that we're in. I did a video on this last year talking about the future growth trajectory of Texas Instruments. That is linked in the description below. But these elevated capital expenditures will depress the free cash flow at least into 2026 before we start to see this investment paying off in 2027 and beyond. But one green shoot is, while they did have a negative free cash flow this quarter of $14 million, in the same quarter a year ago, it was a negative $231 million of free cash flow. And here's another important aspect of this cash flow statement. When there was a lot of uncertainty around the free cash flow expectations for Texas Instruments early in 2024, many people argued that they would have to take on a lot of debt to not only fund these capital expenditures, but to fund their dividend. The video I alluded to earlier debunks that. But what we see is, yes, they did take out nearly $3 billion in debt in Q1 2024, but they didn't take out any debt this quarter at all, and still paid their growing dividend, as well as repurchased $653 million worth of stock. So it does seem like the semiconductor market is finally getting back on the upswing, and other semiconductor-related businesses are having very good days in the market as well. Nvidia is up 3.2%, Broadcom up 5.5%, Intel up 3.5%, and Qualcomm up 4.9%. Applied Materials up 4%. And another semiconductor stock, this time in the semiconductor equipment industry, had a strong earnings report and is also being rewarded by the market today. Lam Research is up 6.4% off the back of their earnings report. But I think a lot of the tariff volatility and potential deals being reached with the Trump administration and trading partners around the world will calm the nerves of the market. And with the growing demand that we're starting to see based on real earnings, real numbers, Texas Instruments could be set up to finally start rising in price over the near term. So what is a good price for Texas Instruments? A lot of my forecasts have been bearish relative to the stock price trading earlier in 2025 and late in 2024 when it was hovering in the high 190s into the 200s. At that time, I had a buy price of $135. But will this strong earnings report finally mean we can raise the target here and find a good entry point for this stock? So for year one, I am projecting revenue to be $16.8 billion. That is 7.6% growth over 2024. My prior projection for year one, 2025, was at 6% revenue growth and $16.6 billion in revenue for 2025. So I did raise my revenue target a little bit based off the strong report here. Operating margin I kept at 35%. However, I slightly lowered the free cash flow conversion down to 40 cents. I had it at 50 cents before, and that is due to the fact that they are going to have the elevated spending still in CapEx in 2025. By year 10, I'm projecting operating margin to grow to 44%, net margin to grow to 36%, and the free cash flow margin to grow to 32.4%. A free cash flow margin of 32.4% is far more in line with the historical free cash flow margin before the elevated CapEx cycle. I have revenue growing at 8.58% per year for the next 10 years, operating income growing at 11.36%, earnings per share growing at 10.93%, and free cash flow growing at 22.65% over the next 10 years. That might seem high, but remember, we're starting from a very low free cash flow point because of the current CapEx spend that we're in. Once it returns to normal, it will be elevated. And you can see down here that gives us a DCF price of $152.61. That's basically what they were at the day before the earnings were released. Their current price is now at $162.83. And here's my bear, base, and bull projections. Starting with revenue, over the next 10 years, we have analog 7% with the bull case going up to 11.2%. And revenue total, I have on a bear case at 6.61%, 10-year CAGR, and the bull case revenue growth at 10.54%. Ultimately, free cash flow is what we're valuing, and the free cash flow margin on a bear case, if they totally miss on all of their future growth and projections, is at 24%. And on the bull case, it's as high as 42.16%. There's a lot of room for error here on Texas Instruments valuation, and a lot of that's due to the fact that we still don't know how the CapEx investments they're making today will pay off in 2, 3, 4 years' time. If they pay off handsomely, as hopefully they will, then we could see a potential bull case here play out. Right now, though, the share price at $163.12 gives us a PE ratio of 31, which is elevated compared to their 5 and 10-year average. We have a forward PE of 31.8, also above their 5 and 10-year averages. My DCF bear case is at $96.29, $152.61 for the base, and $233.30 for the bull case. Texas Instruments does pay a very nice dividend. However, that dividend growth has slowed a little bit in the last 3 years, primarily due to their elevated CapEx spend. But the bear dividend discount case is at $165.56, and that's based on 4% dividend growth over the next 5 years. The base case is at $185.32, based on 5% dividend growth, and their last dividend hike was just under 5% at 4.78%. And the bull case at $209.19, and that's based on 6% dividend growth. I have an exit multiple of $259.71, and that is based on comps of Broadcom, Analog Devices, NXP Semiconductors, Monolithic Power Systems, and Microchip Technology. So you can see on the bear case, there is a bit of downside here, 5.3%. But if they hit the base case, we have about 15% upside. And if they really hit that bull case, very good 43% upside. With no margin of safety, that's a buy price right now of $190.87. With a 20% margin of safety, my preferred margin of safety for a business like Texas Instruments, that is a buy price of $152.69. Yesterday, their stock price would have been under that buy price. However, the market liked what they saw in the earnings report, so now the share price has popped up to over $160 a share. So we would have to wait a little bit, at least with a 20% margin of safety, for the price to come back down before buying more Texas Instruments. But what that means is I'm raising my buy price, my personal preference buy price, from $135 a share up to $150. If you have more confidence in this business or higher risk tolerance, a 10% margin of safety gives you a buy price of $171.78. So even with today's gains, it still might be a good time to enter this business. All in all, I was pleased with this earnings report from Texas Instruments. Not only does it show that Texas Instruments is getting back on track, but it shows broader recovery in the semiconductor market as a whole. We're starting to see the beginning of the growth cycle for this industry. And if you own any semiconductor stocks, this should have very positive impact on your portfolio in the years to come. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.